Katherine Grass es la responsable de innovación en Amadeus Ventures y en Amadeus IT Group, right? Ella va a hablar de Strategic Money, How to Pitch to a Corporate VC, ¿vale? Cómo dar una charla a un VC. Katherine, muchísimas gracias, un placer tenerte.
The clicker for the slides? Perfect, thank you.
Thank you.
Okay. Okay, good afternoon, everyone. I'm Katherine Grass, Head of Innovation and Ventures for Amadeus, which is a global technology company in the travel industry, and we're actually based here in Madrid, the headquarters, literally just across the road, so we're very close. I'm going to do my presentation in English, but if any of you have questions, please feel free to ask also in Spanish. I can speak Spanish, but I'll just prefer to do this in English to get all the right buzzwords in. Okay, today it's about money, and maybe just for a show of hands, how many of you are startups and you are looking for money? Very good. And how many of you have pitched to a VC already, or to someone who has money? Yeah? Okay. Well, I want to talk to you a little bit about strategic money and a little bit about the differences between strategic money and typical venture capital money, because it's very important when you guys are asking for money that you know to whom you are speaking. So the first point here, get this going, is when you are looking for money and you're reflecting on what you want to achieve, you need a plan. You need a plan to how you want to raise the money, specific knowledge and skills, and you really need to be thinking about how you want to execute that. So let's talk about that in a little bit more details. And when I say strategic money, there's some animation in here. What is strategic money? So the first thing I'll say is, you've probably all heard about normal financial VCs. So these are groups that have taken money from potentially different organizations or from individuals, and you are pitching to them, and they're really interested in the financial return. They're trying to find that unicorn. They're interested ultimately in profits and that their fund is successful. With that comes a lot of potential restrictions and a lot of structure. So each of these financial VCs will be focused potentially around certain interest areas, and you need to be aware of that. They might be focused very much around a certain stage of investing. So they might only specialize in seed money, very early stage, or A. And a lot of times this is actually documented within the covenants of their organization, because they have taken on money from individuals or from different people, and they are only allowed to invest in certain stages and in certain ways. So you need to be aware of that. But they're ultimately looking for talented people who are going to execute their idea and bring them financial returns. This would also look, we also call third-party funds. It might be some sort of fund that is also taking money from different corporations or different financial institutions. But again, all of these work very similar in that they're looking for financial returns. When we talk about corporations, and a lot of times you'll see the acronym CVC, or corporate venture capital, corporations are a little bit different, and that's what I want to highlight here today. Corporation and corporate strategic money are companies that you will have heard of. I've put some of them up on here. Like Amadeus, we have a venture fund. Google is up there. They operate a little bit more like a VC, but a lot of these are corporations that are investing in startups for a particular purpose. And so it's important for you to understand what that purpose is before you walk through that door or make that phone call. Then there's also internal R&D that's happening in those organizations, and you need to be aware of what that is. So if you approach a strategic investor like Amadeus, and I'll start to bring in a few little plugs for us and give you some examples so you can really understand what we are thinking when we are listening to you, what do you get? So you've decided to approach a strategic VC. You're probably approaching financial VCs as well. and we do work together. A lot of times maybe investing in the same round, but we can offer you different things. We are not enemies. We find ourselves as complements. I'd like to see what my normal VC colleagues think of that. So what will you get from us? From a corporation, you can be looking, from a corporation side, what will they be thinking when you're in the room? They'll be thinking about innovation. They'll be looking at, to you as an idea of how they can expand and access ideas, companies, solutions that they can't do themselves. So they see you as diversification, as an extension. If you walk in the door to Amadeus, but any other corporate VC, and your mission is to develop a strong competitor product to displace Amadeus from the travel industry, we probably won't invest in you to see if you're successful at doing that. So we see this as an extension, as a diversification. Okay, we might buy you, but we won't invest in you as a startup to see if you're successful. The next thing we want to do with you is we want to enhance our capabilities. We want you as part of our portfolio. We want you to enrich our solution set so that when we're talking to customers, that we have something better to offer. So it really is a complementary and an extension to that strategic investor. It's a way for us to be proactive and continue to see what's out there in the market, to be out there to see what's in our particular industry as well. We're looking at what other things are being innovated around, what are the ideas, what are the trends, and how are those ideas being realized into solutions, and what sort of traction those early stage ideas are getting from the market. Very important, okay? I talked about diversification, and I did put financial returns on here because we are interested in financial returns. But it's not one of our first priorities. So that is the first thing that sets us very much apart from a financial VC. Again, we're not looking for that unicorn. Would be nice, but that's not our sole objective. It's really the complementary ones above. Now, financial returns are important. Why? Because obviously that's good for the startup because it means you're being very successful. And when you're successful, we're successful as investors. And, but we say, let's focus on the strategic objective first, and if those are successful, well, then the financial return will come, and the financial return will follow. So that's, I think, very important. Now, for you, what should you be thinking that you'll be getting out of a corporate venture fund? The first thing is you'll get access to a customer base. Okay? Again, very different than a financial VC. The financial VCs will have contacts for sure. You want to pick the right one. They will have, they'll have expertise, and they'll have a lot of insight in the success and failure of startups and all the pitfalls and things that a normal startup goes through. But a strategic will have access to a customer base. So if you're working in our domain, we can immediately start to introduce you to some of our customers and figure out that working relationship, and it really helps accelerate your idea. We're pilot potential. So if your startup has a solution within the travel domain, there is maybe room to do a pilot with us to help, again, test your idea, test attraction, work out some of the metrics on the KPIs, and we can immediately try to do pilots together within the organization and or with our customers. So that's also important. Industry knowledge. Sometimes startups come from a certain angle of the problem. They might not understand the in and out facets of the travel industry. They might have some questions about how something exactly works within travel, which is the space at Amadeus, and we can help complement that with some expertise and knowledge, okay? As well as operational assistance, though we see a lot less of that now, with the barriers to entry being a lot lower, and obviously the money, okay? Again, at the end. So it's important for you guys to think about what you need, what stage you're in, what you want, but be thinking about what's in the head of a strategic VC when we're sitting there listening to you. and think about what you want or how you could benefit from the relationship. And it's important. Now, these are criteria for Amadeus. Each corporate VC might be slightly different, so it's important to do your research, understand the angle for which each strategic is coming from, as well as have this conversation. Many times we'll ask the startups, okay, what would you like from Amadeus? What would you like out of this relationship? And if they say, well, we want to integrate in your portfolio and we want all your salespeople to go out and sell our solution because we're engineers and we haven't hired a sales team yet and we really expect you guys to sell us, we'll say, oof, that probably won't happen because even though this is around diversification, extension, the best salesperson for your company will be yourself. And to rely on a big corporation to execute and sell for you is probably a little bit too much. Can we integrate you in events? Can we do pilots? Can we get you in front of key customers? Absolutely, but you still need to be responsible for the sales and the execution within your business. So you need to have that conversation. You need to be thinking about exactly what you want, what you need before you walk in the door. I say on the phone because most of it all happens over the phone as well. So, okay. Now a little bit on the differences and similarities, and I'll pull in some Amadeus examples here. Your time is very important. So again, just to reiterate, the planning and the foresight when you engage in the conversations. Now let me talk around these different elements, especially around the investment. So the first thing to realize is the big bubble in the middle. I'll start with the industry and the portfolio of startups. Amadeus, we're a travel company. We invest in travel ideas. If you go into a corporation pitching an idea that's not in their domain, the answer is going to be a very, very quick no. Okay? They're going to have certain areas that they are interested in and they invest around. For Amadeus, it's around big data, it's around personalization, it's around user experience, it's around new forms of content. That is what we tend to look for. So you need to know what our priorities are, because many times our no isn't because the idea isn't good, it's not because the team isn't good, it's just that it's not in one of our priority domains for diversification. So VC might think that idea and that team is really great, but if it's not a strategic priority for us, unfortunately, that'll still be a no. So it's important that you guys realize that, and a lot of times our no's shouldn't be a sign that you're not good, it's just because the objectives aren't aligned. Also bear in mind what our existing portfolio is. Each corporation will already have certain investments. We have a portfolio of 6 and quickly growing. If we have an investment already in a very similar idea, a corporate VC will tend not to invest. Again, this could vary. A financial VC, yes, because they're probably already working around very specific domains. But for us to grow our diversification and grow our portfolio, if we're investing only in a particular sub-segment and have a lot of competing startups in a particular space, it just doesn't make as much sense for us, okay? So it's important to understand that industry and their existing portfolio and their themes or their areas in which they invest. The second area is the preferred investment stage. So this is starting to blur a little bit. It used to be a lot clearer. But this is where you'll get a lot more flexibility with a corporate and a strategic VC. We originally thought we'd invest a little bit more in a Series A, a Series B, for those familiar with the terms, 1 million up to 3 to 5 million. We did not think that really, really early stage startups would want to take strategic money yet, but that's tending not to be the case anymore, and Amadeus is now tending to invest a lot more in early stage and seed. Corporate has that flexibility because, again, they're looking for diversification. They're looking for interesting ideas to see if they gain traction and to work together with you. We're not too worried about if it's a seed and an A, a B, whereas a financial VC might be more worried about that. Many times, as I mentioned before, they might have to stick and stay in a certain dimension and will only be later stage, they'll only be seed, they might only be A, and they'll have a lot more strict criteria around that. So it's important to think about the stage and whether your company is fitting the stage of that investor. The next one is the deals. And this is, understand how many investments that company is making every year. Amadeus, we tend to make around 2 to 4, probably around 3 each year. And so we know that that's how many we're going to invest in. And because we don't invest in 10 or 20, we're really looking for those 3 really, really good ones. So again, we might be saying no because perhaps with the diversification of our portfolio and some of the other companies that we've been investing in, we might say, gosh, this next 3 to 6 months, we really want to find that payment company or that data company or that personalization company. And again, the timing and the fit just might not be there, okay? So again, think about how many companies they're investing in and how you fit into that picture. Exits. You all want to exit, probably, or at least you all want to be successful. The exits are also a bit different. The corporate VC is not going to be as strict on the timing of an exit. So we want to see you be successful, I'll say that, and that success can look like many different things, and ultimately potentially an exit. The financial VCs are going to be a lot more stricter on this. They might be looking for an exit, 3, 5 years. They'll be putting on that pressure. They'll be looking for the future rounds of raising capital, and they'll be putting pressure on that exit. They'll put more pressure than a strategic. So we sort of sit back and let the financials put on that pressure. We want to see you be successful, but again, we're looking for a relationship and we're looking to do something together. So the fact that you won't get that quarterly pressure from us to absolutely be already trying to search for the sale and search for the exit at all costs. Okay, so that's a very important differentiator. Okay. Talk about the investment period. It goes a little bit back to the time. Nowadays the turnaround in startups is so quick that we've seen some already snatched up by the time they even get to the Series A, and you see the Bs, the Cs, and the Ds becoming less and less frequent. And the deal size. So each company, whether it be a strategic or financial, they'll usually have a range, and they'll certainly have an average. So that's always a good question to ask them, how much they tend to invest. In the case of Amadeus, we say we invest maximum 3 million euros per company. Our average is a lot lower because we're finding ourselves doing a lot more seed investments, but we usually won't do anything for less than about 500,000 because that's a lot of, let's say, effort to build a relationship with you for that little of money. And we're not as strict on the amounts because if we did 3 investments each year for 3 million or 3 investments this year for 500,000, the amount of work on our side is exactly the same because we want to build a relationship with you. So that's why we're less concerned about the exact dollar figure and more concerned about the number of startups that we pick to have a relationship with, because again, we're wanting to build a relationship with you. Whereas a financial VC will have a budget and can actually invest that cash in as many companies as they have cash. And so they're not going to be as concerned about the number of startups in their portfolio. They're going to be a bit more concerned about the money that they're actually spending. Okay, so again, a big difference. Okay, So that's the investment. Some of the similarities and the differences and what you guys need to be thinking and aware of before you walk in the room or make that phone call. And maybe talk also a little bit about the softer elements and beyond the financing and beyond the actual investment. So again, similarities and differences here. I'll reiterate understanding the corporate objectives, because we will give lots of no's simply because it's not an area that we're particularly interested in. For example, if you have an online travel agency, we're probably not going to invest in you. If you're just an online travel agency, another Odisio or another Booking.com, if you bring some other really cool feature functionality to that, some other really interesting twist to that with some sort of different content or a different way to match content and personalize it and match it to a user, would maybe be interested. But just another online travel agency, it wouldn't be as interesting. So understanding those objectives of the corporation, their themes, what they like to invest in is absolutely key. And you can usually find that out from the website or from a quick conversation with the company, okay? The next one is the commitment. And I'm a little bit biased here. I'll say the corporate VC will probably go a little bit more the extra mile for you, maybe a little bit more committed, because they're committed to see that that strategic relationship work. Now, it doesn't mean that you can get off being less than stellar. I mean, we are looking for absolutely amazing teams before amazing ideas. And that is absolutely no different than the corporate or the financial VC world. And the typical phrase you'll hear everyone say is that stellar people, amazing people, can pull off mediocre ideas, but mediocre people can never pull off amazing ideas. And we think that that is absolutely true. And we've seen that time and time again. And it's all about execution and how you execute your idea. But the commitment and the testing and helping you maybe see that through from a corporate investor might go just a little bit the extra mile, because again, we're working on pilots with you. We're putting you in front of some of our customers. We're seeing what works, what doesn't work. And with that industry knowledge, we can maybe just help you a little bit more on the industry side than a financial VC, which will have much more expertise on raising the money, putting the business plan together, making sure you're executing, and all the typical mistakes that a early stage company would actually make. On the personal chemistry, I think a corporate VC is maybe a little bit more worried about this than a financial VC. But again, we want to be excited by the person that we're investing in. That's necessarily not any different than a financial VC. Again, amazing people that excite us. You need to be able to sell your idea to us and get us excited, because ultimately you better be selling that idea to customers, and you better be selling that idea to future investors, and also be selling that idea to future exits. Okay? Geography, different and also important. A company like Amadeus, we invest all over the world. We have investments in the US, here in Europe, in Israel, and we're looking to close one in Asia. Because again, we're a global company and we're looking for solutions that work and that are successful, and we're not necessarily bound by borders. A financial VC might be, especially for you guys here in Europe. A lot of US-based VCs are looking over here in Europe to fund you because you tend to be cheaper. But they'll then a lot of times want you to either move to the US because they want you much closer. They want you incorporated in Delaware because then you save them taxes. So you need to be aware of those differences, where corporate VC isn't going to have as many of those types of restrictions and constraints. If someone's not incorporated to Delaware, that's certainly not on our question. We wouldn't really care, okay? And the reputation. Strategic and financial, you want to see what their reputation is. a good startup shouldn't have a shortage of money to choose from. That would be a nice position to be in, right? So you want to pick the ones that have the good reputation, that can help you open future doors. And if you're picking a strategic, you want to align to the ones that have some investment history, maybe talk to some of their existing portfolio companies, and make sure you're picking the good ones where you want that really solid relationship rather than just the first one that gives you money and gives you that check. So those are all very important. So just to wrap up, and if any of you have questions, happy to answer them or take them offline after the panel. Finding funding requires preparation. So, we will probably only take one call with you, and if, we'll give you a very honest yes or no right away, a very honest feedback, and if, we'll say, well, maybe let's talk again in 6 months if you're still trying to grow your metrics or sort something out. But if you call us very green and you haven't done the initial research about what our focus areas are, what our priorities are, what our current investment, and you're asking a lot of simple questions that you could have found out before our conversation, then that wouldn't necessarily impress us and probably not impress a lot of other investors. Corporate money, it is growing. I think about well over 20 to 30% of all money given out in venture capital was corporate money, a lot bigger checks. And so corporate money is becoming much more mainstream. So it's certainly an avenue that you guys do not want to overlook. It's different, so you need to weigh what you're looking for. But it's definitely more mainstream. Corporate investors tend to invest alongside financial investors, maybe in the same round, so it's not either or. So really think about how you can bring in a strategic investor into your portfolio. Think about the extra value that a strategic investor can bring over a financial investor, and if that's something you're looking for, that might be very interesting to you. So really think about the strategic benefits, not just the money, and think around the differences and the similarities around the deals and the financing terms, as well as the elements beyond the financing, right? And finally, I just have to put one plug up here. Again, Amadeus, please look at our website, which all those criteria, filters, and information is on our website. But I was repeating, but I'm happy to answer any of that. You'll see our portfolio as well on there. And of course, you can contact us, and we're happy to discuss your idea in any more detail. Thank you very much.
Thank you so much, Katherine. It's been a pleasure to have you here. Thank you.